morning, and welcome to the internet's only live daily housing show exclusively on BAM. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I discuss housing inventory, Black Knight's home price index, and a bold call on housing affordability. Today is Monday, July 10th, 2023. I am Byron Lazine, and the Hot Sheet starts now. All right. Good Monday morning to everybody. Let me know which market you're tuning in from if you're here on the live chat. And as we do, good morning, Ruthie, from very sunny Las Vegas. I'm sure it is very sunny. I've heard some crazy temperatures out west and down south for sure. I'm in the Connecticut studio today, so hiding from some of those temperatures. It's, I don't know, it's maybe in the 70s today. So hope everybody is doing well. Hit the thumbs up. And as we do every Monday, let's get into a inventory update for the week. Weekly active listings fell over the last 7 days by 866 homes. This is troubling. This is concerning, and this is not good. Okay, maybe just maybe. Obviously, last week had the 4th of July in there on a Tuesday. So maybe, just maybe, we're going to have an explosive amount of inventory in the U.S. next week, and it's going to make up for these last 2 weeks. But it's been bad, right? Last week, remember, Monday, we had about 5,000, 6,000 homes active listings increase. But the week before, or the same week, last year, we saw over 30,000. Well, the same week this year, where we saw 866 homes on the decrease, we actually had over 15,000 homes added to the market same week last year. Okay, so we're talking about in 2-week time frame, comparing last year to this year, plus about 46,000 homes compared to only plus 4,000 or 5,000 for this particular market. Right now, new listings, which we're going to get to in a second, and active listings are both negative year over year. Okay, both trending towards all-time lows. Not good for affordability, which we know is being pressured right now because of the interest rates. So here are the numbers. I'm putting all these charts down below for you in the daily download, which is only on BAMX. All the daily downloads for the housing, for the hot sheet rather, can be found on BAMX all together in one place. So sign up, join me there for all the courses, live streams. I'll be doing a live stream on Friday. Mastermind, if you want to get into that, get into BAMX down below where you get all of these daily downloads. Weekly inventory change from June 30th, July 7th was 465,000 plus down to 464,000 plus. Last year, we rose from 472. So we've been now for 2 weeks negative year over year on total inventory. Active inventories, according to Altos Research, is the homes available for market, not the NAR measurement, which takes into considerations those pending or escrow sales. So same week last year, we rose from 472 to 487. So huge contrast. And if you remember last year, all-time low in inventory the first 6 months of the year. Then the interest rate started going up, and we started to add some inventory, but still, you look at the chart down below, even 2022, when we started to add inventory, abnormally low for active listings when in comparison to 2016, 2017, 2018, 2019, and 2020. Okay. Abnormally low, insanely low. The inventory bottom last year was 240,000. The inventory peak so far this year has been 472. We're actually off of our peak at a time of year seasonally when you start to accumulate more active listings. Active listings for the same week in 2015 were 1.2 million. Okay, 1.2 million, not even close right now, obviously, to what would be considered a more normal market. 2015, 2016, 2017, more of a normal market. We had come way out of the GFC, and things had started to normalize. When you look at across the country, maybe not necessarily your particular market, as an outlier, but when you just go across the country. Right now, the inventory chart, which I'll have down below, shows that we're continuing to maintain, kind of a flat, no growth this week, but really flat number here for 2023. You can see 2022 and 2021, low inventory years. We still had this time of year a seasonality uptick. It's what we typically see in the summer. We're not seeing that right now. New listings. When we look at new listings, this is telling the story here of why we're not adding active listings. It's going down at a time of year when you really do see increases. Even in 22 and 21, you saw much bigger increases. 2022, same week, 90,000 compared to this year's 58,000, 2021, 68,000. New listings are just absolutely getting crushed as we sit here today at a plus 7% interest rate on the 30-year fix. This is locking people in once again. It's the conversation that we were having last year when we hit sevens. We're back in that environment, and there's no sign today for sure of that number coming down. The 10-year today, as investors are continuing to wait to see what happens with the FOMC meeting later this week, is continuing to hover up above 4%. So we do have an update though on projections here for interest rates from Morningstar, but we'll get to that here a little bit later on. But first, inventory being so tight, we just took a look at that. According to Fortune and Black Knight, there was only one of the nation's 100 largest markets that saw a home price decline in May. That housing market would be Austin, Texas, the only housing market out of 100 that saw a decline. The other 99 markets all saw home price increase. Nationally, seasonally adjusted house prices rose 0.71% between April and May. This is, of course, according to Black Knight. And, they're probably number 2 on the pecking order after Case Shiller when you're looking at housing price forecasters. Andy Walden, VP of Enterprise Research Strategy at Black Knight, tells Fortune that tight inventory levels stabilized the national housing market once it entered into its seasonally strong window this spring. Though demand has suffered under the weight of home affordability at near 37-year lows for affordability. Okay, this is what's freezing up the market right now. The persistent lack of available inventory continues to push home prices higher this spring, despite Fed efforts to cool the market by raising rates. When you don't have any inventory to compete over, it's only going to do one thing. It's going to push these prices up. The biggest 1-month gains were found in Midwestern and East Coast markets, such as Madison, Wisconsin, and Hartford, Connecticut. Madison, Wisconsin at plus 1.65%, Hartford at plus 1.58%, Milwaukee plus 1.41%. Not far were markets like New Haven, Connecticut, 1.37% up, Bridgeport, Connecticut, 1.28%, Allentown, Pennsylvania, 1.25%. I can speak to those Connecticut markets. Sure, I'm sitting in Connecticut right now, and Connecticut's got 2 months or less of inventory, where the nation is up over 3 months. So even less inventory here. Now, this little tiny state only produces 2,000 new construction homes a year. So that's exacerbating the inventory issue in some places like the Northeast. Unlike overheated Western markets, which were hit harder by last year's correction, these Midwestern and Northeastern markets didn't see price spike as high during the pandemic housing boom and were better positioned to weather the storm. Among the 100 markets tracked by Black Knight, only Austin, again at 0.33% negative, saw a seasonally adjusted home price decline between April and May. Okay, so 0.33% is essentially flat, but the only one technically into the negatives. I've got some diagrams here for, I'll go to this in a second here. Got some diagrams here for anyone interested down below in BAMX, where you can get your daily downloads. Changes seasonally home prices in May, according to Black Knight, showing really everybody in the positives, the top 100 markets. You can see the Northeast, stronger, up over 1%. Same thing with the Midwest, and then the South, kind of under 1%. And then, of course, Austin being the one market they tracked into the negatives. Here's a shift in regional home prices since the respective pandemic peak, according to the Black Knight Home Price Index. So, decline from peak through May 2023. You have some markets down as much as 14%. That would be Austin, 13.78% from peak home prices to today. You do still see the Northeast and the Midwest holding strong on being either flat or even in the positives for prices since the peak. So that's all available down for you below in BAMX, all in one place if you're interested in that. What I think everybody's going to be interested in is Morningstar's prediction, certainly if it comes true. Morningstar makes a bold call that the housing market affordability will be restored by 2025. It's not that far away. We're in the middle of 2023. Housing market affordability right now is on par with what buyers saw at the height of the housing bubble in 2006. Let me know in the live chat if you believe that to be true in your market. Is unaffordability on par with the bubble in 2006 in your market right now? And let me know what market. I'd love to know. When factoring home mortgage rates, home prices, and income levels, that'll happen when mortgage rates spike from 3 to 7%, of course, and home prices up over 40%. Okay, so there's three levers that can help ease housing affordability moving forward. Mortgage rates, obviously, if those fall, or falling home prices. We just went through the inventory. Where do you get falling home prices when you still have pent up demand? Okay. You may have a market like an Austin as an outlier that saw 10+% drop, but you're not seeing that in most major markets across the country because of these inventory levels. The other thing that can help housing affordability would be rising incomes. Obviously, the Fed has already been outspoken about that. They don't want rising incomes. They don't want more money getting poured into the system with their fight against inflation. So due to the financial market volatility, mortgage rates are always the lever that can have the biggest impact in the short term. It can have, the fastest impact to affordability. If you're, shopping right now, I was on my local radio show last week, and we had a lender on, and 1 week difference from, somewhere around the 6.5, a buyer called them, and then rates were in the sevens, and it was like $150 in a week and a half time frame on the monthly mortgage payment for their particular case, right? And so if you have a 1% drop in mortgage rates, you have a 1.5% drop in mortgage rates all of a sudden. I'm not saying that that's going to happen, but if that were to happen, wow, affordability goes way up, and home prices are still where they are. Okay, so you can afford more of it in the case that happens. Drivers of housing affordability, according to the Federal Reserve Bank of Atlanta, are here: the income component, housing price component, and the mortgage rate component. Okay, so the pandemic housing boom's 41% run up, coupled with mortgage rates spiking from 3 to 7, has seen national affordability deteriorate. A positive figure on this chart means that component improved housing affordability on a year-over-year basis. A negative figure means that component worsened housing affordability on a year-over-year basis. Obviously, we are in the situation like we were in 2006, according to these figures that they're going off here. Okay, so here's what their projection is. This is what caught my eye. Morningstar believes that in 2004, so think about this right now. Mortgage News Daily had us on Friday at 7.14 on the 30-year fixed. Okay, so 7.14 on Friday. We were at 7.22 on Thursday, 7.08%. This is, by the way, what you want to use if you want a general rule of thumb is Mortgage News Daily. I see people on threads like screenshotting Google and screenshotting, and these things are all over the place, and they're really not tied to any accuracy. Freddie Mac 30-year fixed for the week. This is the other measurement you want to look. It's all in one place on Mortgage News Daily. So Freddie Mac's 30-year weekly came in at 6.81. Those are the two numbers you want to look at. What does Mortgage News Daily's daily survey say? And then what's the Freddie Mac 30-year fixed weekly survey? A lot of lenders like the weekly survey. I like to look at the daily one as well. I look at them both, but those are going to be the most accurate. Don't go screenshotting Google. If you want to be seen as somebody that knows what the hell they're talking about, please don't do that. Use this. You're going to have a much closer number to reality. Okay, so that's where we sit today. All right, we know that. Now, Morningstar expects that'll trend down in the second half of this year. It might not even trend down today. So we're waiting, but they expect it to trend down in the second half of the year. They expect our average for 2023 is going to be 6.25%. Well, we got to really start trending down sooner than later to get that as an average for the year, 6.25. Okay, the longer we sit up over 7%, the further down we've got to trend for longer to get that average back to 6.25. But that's what they say, 6.25% for 2023, according to Morningstar. Their forecast model then expects mortgage rates will average 5% in 2024, not 5.25, not 5.5. They expect that the average next year for 12 months in 2024 is going to be 5%. That'd be fantastic, by the way. Anything I think below 5.5% is going to increase the opportunity to get inventory back on the market, because you're going to have people who are just waiting. If I'm making a move from 3 to 5.5, okay, if I want to buy the house and I need a bigger space, or I need whatever the reason I want to move is, I can make that move from 3 to 7%. Doesn't make sense for me to do that. Okay, so we get down to 5%. You're going to see a very robust market. You're going to see a lot of activity. You're going to see this pent up demand. The floodgates kind of open up a little bit, in my opinion. Then they say 4% in 2025. Ruthie, will tiny houses become the affordability issue? Meaning, will they solve the affordability issue? I don't think so. I think tiny houses are literally just the more expensive new version of mobile home parks. Okay, so I think they're more expensive than mobile homes if you actually want to hook them up right and do everything. If somebody gifts you land and you can hook up off their utilities, sure. But if you're actually going to buy land, buy a tiny home, get a proper septic, water, electrical, it's just a fancier version of a mobile home. I think that's going to be a novelty item, and some people will want that, and some people won't. Okay, going back to these rates, 4% in 2025 would mean that in 24 and 25, we're going to have an explosive real estate market in the U.S. If this comes true, what Morningstar is saying, we're going to have a lot of activity. We're going to see transactions go way up again, which would mean that making it through the next 6 months is what real estate agents and brokers and teams need to do. They need to make it through the next 6 months if Morningstar is correct. Next 6 months, though, could be quiet, could be hard to come by a big amount of deals. Keep that in mind on your spending, investing patterns over the next 6 months as a real estate professional. The Fed has engineered a massive increase in interest rates in order to combat high inflation. We expect to cut the federal funds rate aggressively in the coming years, driving the rate down from 5% currently to below 2% by 2025. This is economists at Morningstar's belief. Once the Fed wins the battle against inflation, its priority will shift to jumpstarting economic growth, which will require much lower interest rates in our view. This happens, by the way, the peak that we just saw in 2022 for home prices will get reset in 2024 or 2025, in my opinion. Okay, I know that's just a complete guess, but if I'm looking at the peak, I'm looking at it being reset in 2024, 2025. So for buyers today who are going to be in their home 8, 10, 12 years, you're buying below the next peak. You might be buying below the next 2 peaks in that time frame. But history would definitely tell us on 10-year segments, you're buying below the next peak for sure. Among forecasters, Morningstar, though, is on the low side when it comes to mortgage rates. Okay, heading forward, the Mortgage Banker Association and Fannie Mae expect that the 30-year fixed mortgage rate will end at 4.9% in 2023, and 5.6% respectively. Moody's Analytics expects mortgage rates to drift down to 6% by late 2024 and 5.5% by 2025. Okay. On the price front, Morningstar is on the bearish side. Firms like Zillow and CoreLogic think prices will go up 5 and 4.6% respectively over the coming 12 months. Moody Analytics doesn't see the bottom is in, expects peak to trough decline around 8% for national home prices. So you got some of these differing numbers, just the way it is. Again, we just took a look at the 30-year fix. We're coming into the day at 7.14. We'll see where the read ends up today. Right now, currently, we've got a 10-year at 4.04%. The market, Dow's up a little bit, S&P's up a little bit, Nasdaq's down a little bit. You've got Janet Yellen over in China trying to make some headlines over there. And we've got big inflation data, and then next week, is it next week or the week after? No, it's the week after. So we're 2 weeks out from the FOMC meeting. We got a bunch of inflation data that we'll be going over today. And should you want to join me in BAMX, make sure you hit that link below. I am doing a live mastermind on Friday, recapping the first 6 months of the year and getting into some goals for the last 6 months of the year. We also have all of our courses and our private Facebook group, and of course, the daily download for the hot sheet every single day. All right. Hope everybody has a great Monday. And until tomorrow, toodaloo.